One of the biggest misconceptions about investing is that it's reserved for the rich. With so many investing options available, complicated investing jargon, and a lot of expert advice that often seems to be in conflict, it can often feel overwhelming and confusing as to where to begin. Here are 7 investing tips for beginners. Number 1. Choose your investing goals. Investing is simply a strategy to grow your money over time. Rather than asking, "What should I invest in?" ask yourself, "What am I investing for?" Having investing goals will determine what you invest in, how much money you invest, and for how long. Factors to consider when setting goals include your age, income, risk tolerance, and the time frame. Is your investing goal a short-term one, like building an emergency fund, or a long-term one like saving for retirement? Depending on which path you choose, this will help narrow down the number of investment options available. The other advantage of setting clear goals and timelines is, it will help you determine the amount of risk you can afford to take and which investing accounts should be prioritized. The best investment plan is one that is customized to your lifestyle, as it will be easier to stick to over the long term. Consider consulting a financial planner or advisor to help you come up with a plan. Having a clear investment plan will give you a lot of clarity as you start investing. To quote successful author and speaker Brian Tracy, "You feel truly happy only when you are making progress step by step towards something that is important to you." Number 2. Determine what type of investor you are. Investing does not have a one-size-fits-all approach. Becoming the type of investor you want to be is directly related to your risk tolerance, plus the investing goals you set up. Investors fall into 2 major categories in general: short-term and long-term investors. Someone interested in short-term investing might be looking to replace their current income with revenue made through buying and selling investments. Such activities could include day trading, which involves buying and selling instruments like stocks on the same trading day. This comes with higher risks of loss, but with potentially higher returns. Some might choose swing trading, which involves buying and selling investments like stocks or forex over several days or months, taking advantage of market chart patterns. On the other hand is long-term investing, which involves a much longer time frame and comes with the upside of allowing time for compounding interest. The goal is to determine whether you are a conservative investor seeking stability and the lowest risk, a moderate investor aiming for a balanced approach, or an aggressive investor willing to embrace higher risks for potentially higher returns. Number 3. Choose your investment vehicle. After choosing your investment goals, you need to decide which investment vehicles, also known as investing accounts, to use. Brokerage accounts provide you with the ability to buy and sell stocks, mutual funds, and exchange-traded funds, ETFs. They tend to offer a lot of flexibility with no income limits or a cap on how much you can invest or when you can withdraw the funds. The disadvantage is that you do not have the same tax advantages as retirement accounts. Several financial firms offer brokerage accounts, including Charles Schwab, Fidelity, Vanguard, and TD Ameritrade. Rather than buying individual stocks and bonds, a mutual fund will allow you to buy smaller pieces of many different assets in a single transaction. These investment vehicles pool your money with other investors' money. Mutual funds are typically managed by a portfolio manager. Index funds and exchange-traded funds, or ETFs, are types of mutual funds. When you buy an index fund, you're essentially purchasing a share of the future profits of all major corporations. Index funds track an index, such as the S&P 500. If you buy an S&P 500 index fund, you effectively buy small pieces of ownership in 500 of the largest U.S. companies. It's important to remember that no mutual fund can guarantee its returns, and no mutual fund is risk-free. Robo-advisors offer automated investment management by using computer algorithms to build your portfolio and manage your assets based on your goals and your risk tolerance. The portfolio or investment is managed by computer software rather than a human financial advisor, thus leading to lower fees, which can translate to higher long-term returns for investors. The downside is you have very limited human interaction. Examples of platforms that offer this service are Acorns and Ellevest. For retirement, you have options like 401k through your employer, or individual retirement accounts, IRAs. With a 401k plan, you can choose to invest in one or more funds. Most of the options are mutual funds, which may include index funds, foreign funds, real estate funds, and bonds. A 401k plan is not only an efficient way to save for retirement, but it also allows your money to compound interest tax-deferred. Bonds and certificates of deposit, or CDs, are considered safe investments. Both offer only modest returns but carry little or no risk of losing the principal amount. Understanding the characteristics of these vehicles and how they fit into your overall strategy will empower you to make informed decisions. Number 4. Choose how much to invest. Many financial products have minimum deposit requirements, but you might need less money than you realize to start investing. The earlier you're able to start investing, the better, even if you start small. After you decide which investment accounts you will open, you should consider the amount of money you'll be investing in each account type. How much you put into each account should be determined by your investing goals from step 1. You can determine a fixed dollar amount to begin investing with every paycheck or pick a timeline. This could be weekly or monthly. The other option is to use a percentage of your income to invest. With this option, you could decide to invest 5% of your gross income to a retirement account and take advantage of employer matching of a similar percentage, bringing your total to 10%. You can allocate more money to other investment vehicles at different percentages based on your goals. The advantage of using percentages over dollar amounts is, should you get a raise, the amount could be automatically adjusted based on the percentage in case you forget to adjust the amounts in cash. It's important to remember that successful investing will require ongoing financial education to ensure you are using the best strategies to maximize opportunities. If you are getting value so far, let me know in the comments. Number 5. Pick your risk tolerance. Risk tolerance can be described as the amount of market volatility and loss you're willing to accept as an investor. It defines the level of risk you as an investor is willing to take for the potential for a higher return. It is an estimate of how you would react emotionally to losses and volatility. As we know, all investments carry a certain level of risk with them, and none is immune to having losses. Understanding your risk tolerance is one of the most important factors that will affect which investments you are able to add to your portfolio. One way to determine your risk tolerance is to take a risk tolerance questionnaire. These are made up of a short set of survey questions that will help you understand what your risk tolerance is based on your responses. If you're more conservative in your tolerance, you might have more of your portfolio in bonds and cash compared to stocks. If you have a more aggressive risk tolerance, you may have a higher portion of your investments in stocks which tend to be more volatile. Understanding your risk tolerance will help protect you from making rash and emotionally driven decisions during market turbulence. Number 6. Build your portfolio. A portfolio is simply a collection of financial investments like stocks, bonds, commodities, cash, exchange-traded funds, ETFs, and other such vehicles. Building a portfolio is the process of choosing a combination of assets that are best suited to help you achieve your goals. Following this method allows you to see your investments through the context of what you're looking to achieve, which can be a good motivator to keep going. As you build your portfolio with different investments using the steps that have been outlined, it's important to consider diversifying to minimize risk. Diversification involves spreading your investments across a range of different assets or industries. For example, instead of having all your investments in stocks, you could have them spread out between bonds, stocks, and cash. This strategy helps reduce the impact of poor performance in a single investment and reduces overall portfolio risk. Diversification will also be based on your risk tolerance. A well-designed portfolio will align with your risk tolerance, investment goals, and time horizon, ensuring a sound strategy. As mentioned before, consider seeking out professional help to set up your investment portfolio in a way that's most efficient and productive for you. Number 7. Manage and rebalance your portfolio. Rebalancing is the process of resetting the values of a portfolio's assets to the levels outlined by an investment plan. This is done to match an investor's tolerance for risk and desire for reward. The general rule of thumb is to rebalance your portfolio anytime it has drifted more than 5% from its initial allocation. An advantage of robo-advisors is that they carry out this rebalancing process automatically. As an example, if your portfolio was set up to have 60% of your funds in stocks and 40% in bonds, if stocks experience strong growth, this could lead to a portfolio with 70% in stocks to just 30% in bonds. This is known as portfolio drift, and if not corrected, will result in you taking on more risk than intended and might impact your returns. The opposite of this scenario could also happen if stocks drop in value. Monitoring your portfolio at least every 6 months can help you catch any potential drifts and take corrective action. Monitoring also allows you to assess performance, stay informed about market trends, and make informed decisions based on changing circumstances. Remember, investing requires a great deal of patience. To quote Warren Buffett, "The stock market is a device for transferring money from the impatient to the patient." As you begin your investing journey, keep in mind that investing is a long-term goal that requires discipline, patience, and continuous financial education. By following these tips and staying committed to your plan, you're better equipped to make informed decisions and progress towards achieving your financial goals over time. Comment below which investing tip you found most helpful. Check out my other videos on money mindsets. Like the video and subscribe. Thank you for watching.